Hello, everyone, and welcome back to Sudden Wealth. I hope you're having a wonderful end of the week. Weekend is at the door, and I'm actually quite excited about it. I don't know about yourselves, but here is full autumn, and the weather is completely garbage. It's raining all day long. And to me, actually, the next couple of months will be very hard because we're going to barely see the sun over here. But in any case, enough about me. If you do enjoy the content, don't forget, like and subscribe. Greatly helps the channel. So let's go, because this week was actually quite important. So the Fed spoke yesterday. They pretty much reiterated all the messages that they had. I do think they want to keep rates higher, as much as possible. Will they succeed? Will they not succeed? It's going to be difficult to say. So in the past, what was happening was essentially they were printing money non-stop. So over the past 13, 14 years, they were always printing money and doing QE, and there was no inflation. As I've mentioned before, actually raising rates doesn't help inflation that much as people think. But the audience who's looking at them think that it does. So they are forced to increase those rates. Now, in the past, they would drop the rates as soon as the stock market would fall around 20 to 30%. Why? Very simple. You need to think about, let's take the example of 2018. They were raising rates, but there was little to no inflation, and the economy was fairly stable. So there was nothing really wrong going on. And if they had raised rates, stocks would have fallen like they did at the time, and would naturally actually go up again the same way that we are seeing it right now, what happened this time around. The thing is, at the time, there was no inflation concerns, and there were no big economic concerns. So every time the stock market would drop below certain levels, they would immediately resume QE. And now, with inflation and the perception of the public that inflation is depending on them raising or decreasing interest rates, then they cannot do it. So what's been happening is they've been raising rates at a record pace, and actually things are not breaking down to the extent that they were expecting. And what the Fed is trying to do, for you to have an idea, is actually quite simple. They are trying to raise rates the most they can, the longer they can. Why? So when we see a recession, a big drop, whatever, they can cut rates. But if they are already at zero and they have a recession, there's nothing they can do. So that's the reason behind them raising rates actually quite quickly. I think in the expectation of the effects on the economy coming later, and that way, once the recession comes in, they actually have room to cut. Now, I think that when they cut, they will cut 10 times faster than they raised rates, but we'll see if I'm right or wrong. And I'm actually thinking that maybe by the first quarter of next year, we're going to start to see some weakness, because now the Fed and the banks are saying that no recession is coming. So if you understand anything about markets, if you go back to January of this year, 2023, all the economists were talking about recession. The banks were talking about recession. The Fed was preparing for a mild recession. Everyone was predicting rate cuts by September, October, basically now. Blah, blah, blah. What I said when I created my channel, because all of these people are saying this, then it's not going to happen. But now, last week, or this week, I think beginning of this week, the top economists all agreed that there's not going to be any recession. Okay, that's a very bad sign. That means that most likely now we're going to have one. And the Fed and banks are now convinced that we've escaped the recession, and now it's very little chance we're going to have a recession. Almost for certain we're not, blah, blah, blah. So again, the likelihood of recession just increased dramatically, in my opinion. Now, we tend to accuse China of cooking the books. So let me give you the example of two reports that the Fed looks at, and they mentioned it during this Thursday's event. They said retail sales are very strong. So if you look at retail sales and you compare it to last year, it's very strong. The problem is that report, and now this is how you cook the books, but not very obviously. The part that they don't say is that retail sales are not adjusted for inflation. Big problem. What does that mean? That means that you can have the same volume, meaning the exact same things were bought, or even slightly less. But if the price of those things were up, then retail sales go up. Is that good or bad? Depends. But they never adjust it for inflation, because otherwise, then it becomes obvious that these things are not as strong as they seem. I'll give you another example. Job reports. Oh my God, the job market is so tight. The job market is so strong. The economy is so strong, blah, blah, blah. Wrong. If you actually check, is the job market strong? Yes. But why? Now, here is the question. Is it because a lot of people are getting hired that were unemployed and now they are no longer unemployed? No. If you look a little bit further in the report, you'll see that people getting second jobs is at a all-time high. You see what I mean? That means that one salary no longer covers the bills like it used to do. Now people need two jobs, or they are losing their full-time job but are getting three part-time jobs. So if you look at what happened to the full-time jobs, they also decreased quite a lot, but the part-time jobs increased quite a bit. Why? Because typically part-time jobs, you don't need to pay for health insurance, for benefits, for a lot of things. So is the person better off or worse off? It's actually worse off. But in the report, it will showcase, oh my God, so many jobs created, blah, blah, blah. So this is my point when looking at this data. But at the end of the day, does any of these matter? In reality, no. The reason for it being, if the market believes those numbers are good or bad, or those numbers are important, it doesn't matter if I actually do the work of figuring out how cooked these numbers are. See what I mean? But it's important to know because it will tell you a lot around the underlying economy. So stocks are still going down. The bond market is slightly up and it seems more stable, which is good. So that means that we may be putting in a double bottom in the stock market. Again, S&P 4,200 is the number to watch. And NASDAQ 100, not the normal NASDAQ 100. The number to watch is 14,200. So those two numbers are very important. I think the Russell is actually down versus the low of October 2022. The reason is actually quite simple. And this is why I said in my prediction that Russell 2000, I didn't make a prediction about that specific index because number one is filled with regional banks. So as rates keep going higher, the fear around the banks keeps on increasing. And number two, because a lot of companies, so the Russell 2000 tells you the real story of American economy. Those are the smaller businesses, okay? Unfortunately, throughout the last 14 years, a lot of businesses that shouldn't exist were allowed to exist due to extremely low interest rates. So they got basically free money, and although they were not productive, they were not growing, their leverage was going up, it didn't really matter because interest rates were so low. But as soon as they go up, all of a sudden, these companies get exposed, okay? And these are what we call the zombie companies. Companies that in normal rate environments, which is actually what we've done is to go back to some sort of normal rate environment. These companies start struggling immediately because they shouldn't exist and they were allowed to exist due to extreme manipulation of interest rates. And the price we paid for those years was low economic growth, as resources were allocated where they shouldn't. So this is what you get. This is the price you pay in real time. Are we still on track for new all-time highs by Q1 2024, like I predicted, on the S&P, Dow Jones, and Nasdaq 100? I think so. 4,200 on the S&P, very important. 14,200 on the Nasdaq, also very important. If we put in a double bottom here, that's actually quite positive. We'll see if that's going to be the case. And then 2024 is the election year, and election years, very rarely you see big, meltdowns and things like that, because the Fed, I think, will come to the rescue if that happens. They will give it a pretty name. They will give it a nice name. They will come up with an excuse to do it. But I think you're gonna see it. And the reason, and one of the reasons for it, is, again, you have three sides selling bonds: the Fed, which is tightening; the Treasury, which is issuing debt to pay for the deficits; and foreign entities, either enemy or allies, because they are starting the process of de-dollarization, so getting out of US dollars. So you have three sellers, and you lost the biggest buyer, which was the Federal Reserve. Next year, with all the wars, and Biden is already promising further aid to everybody, that means more and more debt, which means if things get left untouched, interest rates will keep on going up until the Fed needs to come to the rescue and be the buyer of last resort. So I do think we should be about, maybe going to have one last rate hike, and then we're probably going to stop. And I think somewhere between April and June 2024, we will start the process of rate cutting. We'll see if I'm right or wrong, but I do think that's going to happen. So thank you very much, guys, for your attention, and I'll catch you in the next one.